right, Walter Wofford here, short-term rental cash flow roadmap. All right, I got a question for you. I've been a landlord for 3 years now, and I've learned something. And so I'm going to ask you the question. What do you think is the single most biggest expense you have as a landlord? When does that occur? So you're thinking about it, but I'm going to give you the answer, at least in my opinion. It's when you have a turnover and vacancy. You got to go in there and fix up the house, and it takes all your profit from the last 2 years and the profit from the next 2 years. Anyway, turnover. So I've got a model to show you today, and it's about a joint venture with a short-term rental that will keep the tenant, me in this case, in the house for up to 5 years with no turnover. Would you like to see how that works? All right, so I got my AI team, Bill and Judy, working on the content and delivery. So here they come.
We just cut so many people off.
You know, in a world just absolutely flooded with information, right? Every click, every scroll, it promises some new must-know fact. How do you actually cut through all that noise? How do you get to what really matters? Especially, how do you get genuinely well-informed and quickly in a market that's just moving so incredibly fast? Well, that's what we try to do here on The Deep Dive. Today, we're plunging into the short-term rental market. It's incredibly dynamic, and we're zeroing in on a pretty clever strategy, actually, one that's really reshaping how properties are managed and, well, how wealth is built. So our core subject today is the joint venture model, the JV model. This deep dive, it's really about revealing exactly how a real estate investor and an STR operator can partner up. Not just to, maximize a property's potential, but to create a truly synergistic, a real win-win situation for both sides. It's about seeing how different strengths, when you combine them strategically, can lead to some pretty exceptional results.
Yeah, and what's truly compelling about this model, especially right now, is just how accessible it is and how elegant. It offers this powerful structure for investors, right, for generating passive income from real estate. But at the same time, it empowers skilled operators to build a scalable, profitable business without that huge hurdle of actually owning the property outright. Understanding this, it isn't just about real estate, It's kind of a shortcut to grasping a powerful framework for collaborative wealth creation.
Okay, that sounds like a fantastic promise. A win-win, expertise meets capital. But how does this joint venture model actually play out? Like in the real world, how do these two different roles really come together?
Yeah. Well, at its heart, it's a direct, pretty strategic partnership. So on one side, you've got the real estate investor. They're the capital partner, their main goal, long-term asset ownership, and a steady stream of passive income. Then on the other side, you have the short-term rental operator. Their goal is leveraging their management expertise, to build a highly profitable STR business. And crucially, without having to buy the property themselves. The genius really is in this perfect alignment. Both partners are basically motivated by the property's success, just, from different angles.
Right. And this is where it gets really insightful because we don't just talk theory here. We actually have a real-world example to walk through with numbers. So let's imagine this property, 5040 Old Canton Road in Jackson, Mississippi. Let's call it the Canton Corner House. Sound good?
Perfect. So for the Canton Corner House, the appraised market value came in at $200,000. But here's the first smart move, right? The operator, using their market knowledge, their negotiation skills, they actually secured it for just $140,000.
Wow. Okay. That's quite a discount.
Exactly. That's 70% of market value. Pretty remarkable. Then you factor in, say, $20,000 for essential renovations and, stylish furnishings. That's vital for making it STR ready, appealing to guests. So the total investment by the joint venture partner at the capital side comes to $160,000.
Okay, $160K all in for the investor.
Right. And in this setup, the operator, they're the one who did the legwork, finding this undervalued deal, negotiating that incredible price. The joint venture partner then steps in, funds the whole $160,000 purchase and setup. And here's a really critical detail for the long game. The agreement includes a clear exit plan. The property is earmarked for sale after, say, 10 years. And when that sale happens, the operator earns a full 50% share of any net profit. That's profit above the original $160,000 investment.
Hold on, 50%. Even though they didn't put in the capital for the purchase.
Exactly. Think about that. They're earning appreciation on an asset they never actually had to buy.
That's powerful. So, okay, we have the initial investment, the long-term plan. But what about the income, the cash flow during those 10 years? That's where this performance lease model comes in, isn't it? How does that piece work?
Precisely. The performance lease model, that's really the engine for the consistent cash flow here. So under this arrangement, the operator leases the property directly from the JV partner, who is the owner. Now, this is designed to give the owner a guaranteed baseline rent every single month. Very predictable return. Plus, there's a dynamic bonus component. It kicks in, and it's tied directly to how well the STR operation performs.
Ah, so it rewards performance. Makes sense.
It does. Let's apply it to the Canton Corner House. The owner gets a minimum rent, let's say $1,200 a month. That's $14,400 annually, guaranteed. Doesn't matter about bookings.
Okay, $1,200 minimum. Solid baseline.
Then there's a bonus threshold. Let's set it at $4,000 in gross monthly income from the STR. So if the property generates, say, $5,500 in gross rental income 1 month, that's $66,000 annually if it keeps up.
Right, which is above the $4K threshold.
Yeah, exactly. So the bonus calculation activates. The owner gets 25% of the income over that $4,000 threshold. So in our example, 25% of $1,500, that's the $5,500 minus $4,000.
Okay, so 25% of $1,500, that's $375.
Yep, $375 per month extra for the owner. Adds up to another $4,500 annually. So in this scenario, the total rent paid to the owner becomes $575 source dollars per month, or $18,900 annually.
Got it. Minimum plus a performance bonus.
Right. And what's really important to grasp here is that the operator, after they cover all the operating expenses, cleaning, utilities, marketing, any repairs they get to keep the difference between that gross STR income and the total payments they make to the JV partner.
Ah, so that's their incentive.
Right.
Maximize bookings, keep guests happy, because the extra cash flow beyond the owner's cut is theirs.
Precisely. It creates a really powerful incentive structure.
Okay, that makes perfect sense for the operator. But let's flip the coin. From the owner's side, the JV partner.
Yeah.
What are the big advantages? And maybe what are some things they need to consider with this model?
Great question. For the owner, the advantages are pretty compelling. First, stable minimum income. Those consistent monthly payments, that's huge comfort, right? Especially in a market that can fluctuate.
Absolutely. Predictability is gold.
Second, there's that bonus upside. If the operator really knocks it out of the park with the Canton Corner House, the owner sees extra income without lifting a finger, basically. Third, and this is often the most appealing part for many investors, it's truly passive ownership. The operator handles everything: marketing, guest comms, cleaning, maintenance, the whole shebang.
So truly hands-off.
Totally. You're freed from the daily grind of being a landlord or STR host. And let's not forget, as we saw, you acquire the property at a significant discount from its appraised value. That builds an equity right from day one.
Okay, those are strong positives. What about the considerations, the potential downsides?
Sure, there are trade-offs. One is a limited monthly upside compared to, say, other models. While you get a bonus, the operator keeps the larger chunk of the profits once that rent and bonus are paid. This is different from maybe a traditional revenue share where an owner might get a fixed percentage of all gross bookings, before expense.
Right, like a 70-30 split of gross revenue or something.
Exactly. So with this performance lease, your total income in really high peak months might be lower than with that kind of revenue share. It's basically a trade-off. You're trading potentially higher peaks for that guaranteed baseline, the stability, and the completely passive nature of the investment.
Okay, that trade-off really clarifies things. So this raises an interesting point about who fits best. Who is this particular JV model really ideal for?
Yeah, it's definitely tailored. This model is perfect for investors who really prioritize steady, predictable income, but still want some upside potential. It's truly the low-maintenance way to get into the short-term rental market, which can be pretty lucrative, without actually becoming an active landlord or property manager. If you want your capital working for you in STRs, but you really don't want to deal with guest calls at 2 a.m. or fixing leaky faucets, this is probably your sweet spot.
That makes a lot of sense. Low hassle, steady returns with a kicker.
Yeah.
Okay, so beyond the monthly cash flow, which is certainly appealing, what's really fascinating here is the long-term wealth building aspect. How does this model build significant wealth over time, especially considering the operator doesn't technically own the asset?
Right. That's where the exit strategy, that 10-year plan, really brings it all home. The property isn't just a cash flow machine month to month. It's an appreciating asset. We expect the Canton Corner House to grow in value over that decade.
Okay, so walk us through that projected exit.
Let's do it. Our initial investment number, purchase plus renos, was $160,000.
Got it, $160K.
Now, fast forward 10 years. Let's assume, maybe even a bit conservatively, a sale price of $220,000.
Okay, $220K sale price.
That gives us a $60,000 gain in appreciation. $220K, $160K.
Right. Simple math.
Now, this net sales profit, the 60K, it gets split 50-50 between the partners. According to the agreement,
50, so $30,000 each.
exactly. 30K for the JV partner, 30K for the operator. So this means the JD partner's total return from the sale itself is $190,000. That's their original 160K investment back, plus that $30,000 profit share.
Nice return for the investor.
And crucially, the operator, who, remember, never owned the property directly, never put in that initial capital, they still walk away with $30,000 from that profit share on top of whatever profit they made operating it over the years.
Wow. So they get operational profit and a slice of the appreciation.
Precisely. This approach, it beautifully rewards both partners for what they uniquely bring to the table. The owner gets that consistent income all along and realizes significant capital appreciation when they sell. Meanwhile, the operator builds a profitable rental business year after year and shares in the property's appreciation without the burden of ownership or the big capital outlay. If we connect this to the bigger picture, it's really a testament to leveraging different strengths, isn't it? Capital meets operational expertise. It creates something bigger than either could do alone.
That is a really powerful illustration of leverage, yeah. So when we boil it all down, why does this specific JV model work so well, maybe better than other partnership structures you might see in real estate? What's the secret sauce here?
Well, I think the secret sauce is kind of multifaceted. First, it creates truly aligned incentives. The operator is intensely motivated, right? Maximize rental income, keep guests happy because their bonus and their long-term profit share directly depend on it. That gives the owner genuine peace of mind.
Alignment is key. Got it.
Second, it brilliantly enables creative financing and wealth building for both sides. The capital partner gets exposure, the operator gets to scale. It sort of democratizes access to these kinds of potentially high-yield real estate investments. And finally, it just masterfully balances risk and reward. It offers stability and predictability for the owner. And at the same time, it provides real scalability and significant long-term upside for the operator. It really is a blueprint for mutual success.
This deep dive into the ultimate STR joint venture model, it really unpacks how powerful these creative partnerships can be, not just for scaling STR businesses for operators who don't have huge capital reserves, but also for passive investors who are looking for both that consistent cash flow and, significant asset appreciation down the line.
Absolutely. I mean, when parties come to the table with really clear agreements, shared goals right from the start, they can navigate today's, let's face it, dynamic STR market with exceptional success. They build something far more impactful together than they could apart.
So for you, the listener, the takeaway here, it isn't just about the nuts and bolts of a real estate deal, right? This model, it brilliantly illustrates the immense power of structuring any kind of partnership where the incentives are perfectly aligned, where different strengths genuinely complement each other in a truly synergistic way. So maybe the question to ponder is, what stands out to you about how this kind of collaborative win-win framework could potentially reshape things? Not just real estate, but maybe any venture where resources and expertise can be creatively shared for exponential mutual growth.